Is the U.S. stock market in a bubble? More precisely, are stock prices just too high to be sustainable? Are we in for another big decline like those following the market peaks of 1929 or of the tech bubble of 1999? What metrics might one use to evaluate that? Valuations? Sentiment indicators? The use of margin? Today, as your co-hosts consider these questions, we begin with a thought-provoking paper published in February 2021 by Ray Dalio, the founder of Bridgewater Associates, one of the largest hedge funds in the world. That paper is titled simply Stock Market Bubble. After summarizing Dalio's analysis and argument, we then ask, is it possible that in a world of extremely low interest rates, or of the Federal Reserve flooding the system with liquidity, that current market valuations actually are justifiable? In other words, is it different this time? So on the one hand, if it's not different this time and we are in a bubble, what might the consequences be? Or, on the other hand, if we're not in a bubble, or at least not in a full-fledged one, is it nevertheless possible that today's historically high valuations should temper investors' growth expectations over, say, the coming decade? Or is the best policy just to assume it will be business as usual, with portfolio growth rates consistent with what we've come to expect over the last 50 to 100 years? In the absence of a crystal ball to help us answer these questions, what steps should you take to avoid having your financial goals derailed regardless of the outcome? Should you reposition your portfolio to be ready for the future based on your predictions? Or is it workable to wait for the future to tip its hand before making any such adjustments? Stay tuned as we consider all that and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I am your co-host, Roshan Loungani, here with another episode for you. We're back as usual with Erik Olson and Adrian Nicholson. Erik, I see you are no longer in Crystal Lake
That's
week.
Right. Back in Zeeland, Michigan. Yes, it's fantastic to be home.
Back on Eastern Standard Time, right? Adrian, how about you? How are you doing?
I'm doing good. I just wanted to mention, Erik, you are very mobile. Can you do you have like a superpower where you just teleport? Because I feel like every time you join like a virtual meeting with me and Roshan, you're in one state and then you're in the next state.
Yeah, we should probably set a little a tracker and see how many different places can we do these episodes from.
I know.
Well, you've recorded from Seattle as well. Yeah. I remember that.
Yeah.
Correct.
And so, I think you challenged me to do it from a mountaintop or something, didn't you?
I was literally about to say that. We still need to get you on a mountaintop to record an episode, but hopefully like a bear doesn't run up on you while you're recording.
Yeah, that'd be great. That'd be great.
It'd probably be our most popular episode.
That'd be great.
An unexpected guest interrupts our episode.
Yeah, clear out for that interview, right?
Yeah. So today we've got an interesting topic for you, Adrian. Actually, why don't you give us your initial thoughts and background on what we're talking about today?
Yeah, of course. Today we're going to be talking about bubbles, and I know that sounds kind of interesting. The first time I heard a bubble in one of my classes, I was just like, "What are you talking about? Like, what is this?" And we're going to be talking about a stock market bubbles today. Some of the features that make them unique, what you need to know about them, how you should really react about them. And I think it's going to be a very interesting topic today. And it's also one that kind of brings up a lot of heated discussion when it comes to bringing up, are we in a bubble? Are we not in a bubble? Like if you're on YouTube, if you're on Reddit, if you're just having a conversation with somebody saying, "Oh, I think the market's just extremely overvalued right now," and somebody says, "Oh, that's not the case. I think it's completely rational where the prices are right now." You can get a lot of back and forth, and it's always a big topic that people discuss, whether it's on the news or whether it's just colleagues talking about it. It's always a very interesting topic because it's happened throughout our history, And you always hear these conversations, is it going to be different this time? People are concerned with certain price levels. It's always something that really intrigues people and really just gets discussion going. And I think we're going to have another great topic today. We have an article that we're going to reference. We're going to kind of give our little opinions about it. And I think it's going to be another great topic.
Yeah, and to start us off on this, on the bubble topic, what prompted this conversation is Ray Dalio, who is who founded the world's largest hedge fund, Bridgewater Associates. He put out a report using their metrics and talking about a bubble. Now, he thinks we are in a bubble. We want to go over some of his analysis. Then we've got some additional data that Erik has pulled. And then when we are finished talking about whether we're in a bubble or not, we want to talk to you about, well, what do you do with how do you execute on your opinion in the bubble or not? So, gentlemen, I'll start us off right away with Bridgewater's metrics. They have 6 different metrics they use to determine if we're in a bubble. The first is how high are equity prices relative to traditional measures. That means how high are stock prices. Second, are prices discounting at unsustainable conditions. That means when you're looking at the present value of the prices, is the rate of growth you need on an annual basis higher than is realistic? Third is how many new buyers have entered the market. And specifically what he mentions here is something that we've heard a lot and talked a lot about are a lot of younger people, more retail Robinhood investors, the Reddit space with, GameStop, AMC with what happens. Those are the type of investors he's referring to in here as far as newer investors that haven't been in the market before. The fourth is how broadly bullish is sentiment. That means, does everyone think things are going up, essentially, or the vast majority? The fifth is, are purchases being financed by high leverage, which is, are people buying stocks using either A, high leverage with margin loans, or B, are they using options? And what's interesting with this one is that is definitely taking place, but it's more in certain types of growth stocks, which tend to be more favored by the newer retail investors, using more in options. The last one is, to what extent have buyers made exceptionally extended forward purchases? What this means is, are buyers purchasing things now that they won't need until the future just because they think prices will go up? We talked about this a little bit in our inflation episode, but the one thing that comes to mind for me is a real story. I've got a friend who is he does home renovation work, and so he went out and bought a bunch of lumber and has it stored in his garage. Now that's one instance, but that's exactly what they're referring to. Interestingly, 3 of their 6 gauges that they use are saying bubble. 2 of them are saying we're in a frothy market, but not in a bubble yet. And 1 is somewhat frothy, which is a little bit below that. So Bridgewater believes we're in a bubble. And we're going to discuss a little bit more in terms of data points as to whether we are or aren't in a bubble. And as I said, what we should do about it. So, gentlemen, I went over the 6 areas and that Bridgewater thinks we are in a bubble, but they don't think we're at the top of the bubble based on what they've described. Any initial thoughts on any of the 6 items or bubble talk in general?
Adrian, I've got some ideas. How about you?
I think Adrian has ideas, but I think he is no longer with us in the chat. So,
okay.
Erik, why don't you start us off?
Sorry, Adrian. I was looking at my PDF of this particular article. And so, by the way, folks, this was published by Bridgewater Associates in February of 2021. So you're able to just Google that, Dalio, the stock market bubble, and you should find it. So I guess I would say I'm gonna
hold on, Erik. Before you move on, since you gave the date, you mentioned this at the beginning. Where are the markets now compared to when?
Well, they're about as of the publication date, which might be a little different than the date on which they gathered their data. But the market's U.S. stock market is represented by the S&P 500 is about 12% higher still than when they did this. So if, whatever characterizations they had at that time from a valuation standpoint, at least, that doesn't apply necessarily to the other of the 6 measures that you mentioned, but at least on a valuation measure, it would be somewhat more extreme, I guess you might say. So having said that, I guess I would just point out the reference points that Dalio uses. It's kind of interesting. He uses the roaring 20s and says on every one of those measures, with the exception of the buyers and businesses have made extended forward purchases, that was for sure a bubble on every one of those 6 measures, except the last, which he says instead was frothy. Then the second major moment that he uses as a point of comparison is the .com bubble, and all 6 of those were in bubble territory. Interestingly, he does use 2007, and in that case, 2, he would say, were not bubble. Namely, there was no bubble at all, specifically whether prices were too high or whether prices were unsustainable. Frothy in the categories of new buyers have entered the market, and there's a broad bullish sentiment, but bullish, or probably bubble on leverage and on people having bought a lot of stuff in advance of actually needing it. Today, he separates it into 2 categories. One would be the market as a whole, and then secondly would be emerging technology companies. And so Roshan, why don't you talk about that distinction between those 2 sets?
Yes, thank you, because I needed to correct what I said previously, so I appreciate the chance to do so. When I initially said that he's got 3 in a bubble, 2 in frothy, 1 in somewhat frothy environments, that is the emerging tech space. And you've got in the total market, he's actually got nothing in the bubble category. So what to me is very, very interesting about this is you've got this emerging tech space that is at such an extreme that he's saying that we are close to a bubble because of it. That's driving a lot of the total market to frothy areas, but not in a bubble. And I think of initially when I hear that and read that, I just think of last year, right? And if you think about last year, 2020, the pandemic hit, the market drops almost 40%. The S&P recovers a little bit, but then right before the election in November, it was flat on the year, and the NASDAQ was up at that point like 30, 20+%. It may not have been 30 at that point. I don't remember the exact number, but then the S&P ends the year up like roughly 11, and the NASDAQ is up over 30, right? So to me, I'm using those indices because I monitor them close enough to remember those exact data points, but also NASDAQ is tech, S&P is total market. Right. So you've just, that to me, that rapid appreciation. Now, granted, NASDAQ is not all emerging tech, but I think it's a good proxy to use to compare the 2. And it lines up with his analysis of tech being more frothy and more of a bubble versus the entire market. If you also just extend that to real life and what was going on at the time, you've got people working from home. People are starting to use all this technology, all these tech stocks, Microsoft Teams, Zoom, just to name a couple that come to mind. But there are other things for remote collaboration that people are using. And then you've got security needed on all these remote collaboration working environments. It makes sense that the tech stocks were going to go up. And at the same time, when you get into that mindset of last year, even November, right before the election, well, the economy's still closed. We don't have a vaccine yet, which the following week comes out, and things are opening up. So if you think of it beyond just market conditions and data points and what was going on in real life, it also lines up really, really well. A year ago, would you feel more comfortable investing in an airline stock or in Zoom? You know what I mean? When things are
Yeah.
closed.
Yeah, I'm following what you're saying, Roshan. And that's also kind of one of the things that are kind of one of the features of bubbles. Sometimes there's always just so much rationale, or it just makes sense why the prices are going up. And sometimes that can lead to confirmation bias. Well, I understand why technology stocks are hitting all these high. People are relying on tech more and more. And I think that that's always been kind of some of the features of past bubbles where, you know, it's just going to go up and up. There's all these like reasons and all these reasons why we can justify these high prices. And then some type of like moment happens or something that changes. And then that's when the price pullback happens. And I think that's always a distinguishing feature and something people always need to look into when you always see these prices going up and up. What's the rationale behind it? And what is kind of pulling back the curtain? What else are you maybe not seeing?
You know, to your point, I'm not going to mention the ticker symbols, but there's a widely followed exchange traded fund that has had as its focus precisely this category that Dalio is referring to as emerging technology. That particular ETF, which caught a lot of attention and hence a lot of assets, rose to a peak just a couple weeks after this article was published. And then since that time, even after incidentally a recovery more recently, it's still down 25% off of its high point in mid-February. So at least in that sense, this article published in February was, I would say, somewhat prescient in that it identified that this category of emerging tech was bubble-ish or highly frothy, and indeed it has cooled off since that point in time. Whereas the S&P 500, which he hadn't characterized as in bubble territory, or at least the broad market hadn't been characterized in that way, has continued to rise since that time, as we previously said, by 12% since the beginning of February.
Yeah. His article is definitely interesting. And I found, as you just described, and as we talked about, splitting the two segments up was very important. We'll go into the next thing a little bit more that I'm going to say, but I want to, Erik, you to share some of your data. But the one thing that I think is missing is how the interest rate environment impacts things. The fact that interest rates are so low. But let's come back to that. And Erik, can you share some of the data that you've pulled as well that will indicate, are we or are we not in a bubble?
Yeah, so folks have heard me mention before that I tend to think statistically or at least quantitatively. And so I thought, while on the one hand, I want to read what I can about some of these other sort of influential figures in the thought process of our business as a whole, I thought it would also be useful for me to just download some data and do some statistical analysis on that myself. So by the way, I'll just mention that you can do precisely what I did if you have an internet connection and an Excel if you have Excel, Microsoft Excel on your computer. So the data that I used in the main came from two sources. One, if you go to finance.yahoo.com, you can download data for any variety of indices or stocks or exchange traded funds or what have you, going back pretty far. And so what I did is I got the daily data for the S&P 500. There's an index there and you have to find the code. But anyway, you can go back as far as the end of 1927 and get daily data all the way back that far. So that was one source. And then the second source is at Yale University, Professor Robert Shiller has maintained a page, I think going back since the early 2000s, where they make available to anyone who wants it the data that they maintain for a number of ratios. So one of those is known as the cyclically adjusted price to earnings ratio, or sometimes nicknamed the PE 10, meaning the 10-year version. And we've talked about that in the past, so I'm not going to go through the process of redefining that. But if you want to track down Shiller's data set, you can look under Yale Shiller data. Irrational Exuberance is the title of a book he published in the late 90s or early 2000s. Anyway, you can find the data yourself. And then with Excel, you can do the plug-in, the analysis pack, and you can do linear regression analysis, which is a technique that I used. So bottom line is without wanting to overwhelm you with detail, let's just start with this CAPE ratio. What I did is I wanted to look at it looking forward 1 year, 5 years, 8 years, 10 years. Does the valuation measure, that was the first of the 6 measures that Dalio referenced, does using valuation, in this case the measure of choice being the CAPE ratio, have any sort of predictive power about the returns that we should expect over the next X number of years? And it seems as that the answer is yes, though not perfectly. So we're currently, the CAPE ratio is at 40. That's pretty doggone high. And though it's been higher, when it's this high, the forward 10-year return, the total return to the S&P composite, using it and pulling out inflation, is actually slightly negative. So think about that. After adjusting for inflation, the sort of midpoint expectation that we would have for the next 10 years would be, given our starting point today, that we would have essentially no real growth even after factoring in dividend and buybacks. Now, I hope we're wrong. And Roshan will be, and we'll actually all of us, but Roshan, I think particularly, will be arguing for the consideration of how extremely low interest rates are right now and why it does make it somewhat different this time. But just as an overall backdrop, I would say that while on the one hand, we might expect positive returns even after inflation, maybe even with inflation, maybe even a 10% compounding return over the next decade, we could, I think, say with equal plausibility that we might see, even after adding back in inflation, a minus 4% per year over the next decade. So bottom line is that it doesn't help to start at these really, really high valuations. And so whether or not we're in a bubble per se, setting your expectations to be realistic about what the markets may offer, I think is a prudent step as part of your overall financial planning process, because that's ultimately what the three of us do, is we do financial planning. And if you start with, I would say, rose-colored glasses in your assumptions about what the markets will do, and then they don't, you're setting yourself up not only for maybe a disappointment, but maybe some hardship. So I'd rather start with the starting point of, let's be conservative in our assumptions about what to expect. And then if we get better than we expect, hey, that's all gravy. Guys, thoughts?
I like the going conservative, and I do have some take a little bit of issue with some of the analysis, but I wouldn't necessarily say I'm bullish on the markets either. Another indicator that is often used for this, it's called sometimes the Buffett indicator of total market cap to GDP. And it's predicting an expected forward return of minus 1.4%.
Kind of lines up with the number that, although that one might not be inflation adjusted and mine was. So it's interesting that there's some agreement about those. I'm not saying that means that that's true, but or that it's valid, but it is interesting that there's agreement between those two.
Well, and here's where I take issue with some of this analysis. And once again, this isn't saying it's wrong. This is just saying that I'm looking for what can I do about it, right? Essentially, if someone's listening to this show, or even me and speaking with clients, it's, well, we take this data, we take this information, and I actually think it's tough to argue that the markets are not overvalued, right? But then you've got to look at, well, why are they overvalued? So the first thing that comes to mind for me is just the low interest rate environment. And if you take that a step further, this whole low interest rate environment, and you think of it, well, what can you do as an investor using Dalio's numbers, well, if you own those frothy emerging tech stocks, you can sell those and go into regular stocks, total market type stocks, or dividend stocks or value stocks, which have shown some recovery and some they've been doing pretty well the last few months. So you can move there. What you're not going to do is go to bonds with how low the rates are. Right. So you're transferring from one stock to the other versus going from a stock to a bond, and going from a stock to a bond is what could, in fact, lead to overall market declines. Going from one stock to the other, yes, it will lead to a sector going down, but it's going into another sector. Another thing I'd love is now, I remember using some of these indicators in 2013, 2014 range, because the markets looked overvalued. You had the same negative data. And this was actually in 2013 because I remember the markets were way up that year. I think they were up about 30% in 2013, if I remember correctly. So it just shows you, even Dalio mentions this in his writing, that, well, just because even if all the indicators say you're in a bubble, doesn't predict when. Bubbles can get bigger. Right. And so and this is where one of my favorite quotes when it comes to something like this, it's by Peter Lynch. And the quote is, "Far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves."
Interesting.
That's timing, right? Timing the markets.
I'm sorry, Adrian?
This is very similar to just trying to time a bubble. Can be just very difficult. And just going back to the data that you brought on, Erik, I'll just touch on that real quick. I think it's really great, especially when you're, doing your financial plan. Just plug this scenario and plug this data in and see how that could just impact you. Just running the more scenarios, the better. And sometimes going with a conservative assumption too is just very beneficial. And then Roshan, what you what you talked about on Erik's point, it kind of makes me a little bit worried where, if there's such a low interest rate environment and bonds aren't giving you the yield that you need, and you're just all in basically stocks, that really takes diversifying really out of the equation, where, you want to diversify in stocks and bonds, but you're not getting a lot from bonds. Are you supposed to look into alternatives, not just alternative investments, but shorting's a big thing when people are talking about bubbles? They're shorting. Doing options. There's inverse ETFs. There's a bunch of new products out there that you can use in a market. But just, the importance of diversifying your portfolio is bigger than ever when you think there's a bubble. How would you respond to that?
Yeah, a very good question. So if you look at the current interest rate environment, and if interest rates are below, let's call it 4.5, just because we just looked at two data points, and I couldn't remember the old one that was set at 3, but we just saw one that said over the last, I think it was 30 or 40 years, it's around 4.5. If interest rates are below 4.5, stocks and bonds are going to go in a similar direction. If they're above roughly 4.5, that's where you get the negative correlation, which is where the power of diversification comes into play. So, Adrian, you're right that regardless of whether the number's 4.5, 3, or whatever it is, when interest rates are as low as they are now, bonds aren't going to be the great diversifier for you. So alternatives are definitely another place to look where you can see things that can diversify you. And with alternatives, these are looking into, in many cases, investments that are just not public, and just because they're not public, you're not going to see their price move on a day-to-day basis. But at the same time, you've got to look at what you're investing in. Just to give you a really simple example, if your investment portfolio is in real estate, and then you go out, your public, regular equity investments are in real estate investment trusts, and then you go out and you buy an alternative investment, and you decide to buy an apartment building. Granted, they're different. One's public, one's not. One will move up and down day to day, the other won't. But the factors that impact them may be the same in the long run. So though you may not have to deal with the stress of seeing things move as quickly or as rapidly, the outcome of your investment may be similar. So I give you that detail because I don't want you to say, well, let me just look at alternatives and any alternative will be a diversifier for you. That won't be the case. You've got to look at what you're invested in currently in the regular stock and bond market, and then look at an alternative that will be a diversifier beyond just the fact that it's private.
So I'd like to, Adrian, did that satisfy your question? Because I'd like to follow up on something that Roshan said.
Yeah,
Okay.
More than satisfy. That's got to be a clip right there, what you just talked about, Roshan. That was some really good content. Thank you for that.
Yeah, hopefully I get a dislike again.
Oh, that's funny. So I'm going to challenge what you said in there, Roshan, though, about the correlation question. And here's why. That is to say, the correlation between stock price movements and bond yield movements. So it is, as you pointed out, historically the case since 1965 that when you're in very, very low interest rate environments, and I think the number I saw that was published by JP Morgan in this particular respect was 3.6 or lower, pretty much uniformly, that yields are, if yields move one direction over the next couple of years, stocks are going to be moving in the same direction over the next couple of years. I think actually that makes actually the stronger argument for using bonds as part of a diversifier. Here's why. If the yield of bonds is moving up, the price is moving down. And so in that sense, so while stocks are moving up, the bond prices would be falling. That seems to be correlated, but the inverse is also true. At low interest rates, if stock prices fall, then bond yields, we would say again, are likely to fall, but bond prices would rise. And that's precisely what I'm after in that kind of instance, is that the price of my bonds will move in a different direction than my stock prices will, for that diversification effect.
Yeah, so when you're looking at bond prices and what's going to drive them up, there are two things that come to mind, right? One is an investor saying, I want to get a X% return, and they get that fixed rate of return on their bonds. They're buying into bonds, or it's because money's going out of stocks and going into bonds. That's another way. And then the final one is if the Fed's cutting interest rates, bond prices will then go up, right? So you can't really cut interest rates much more. And so that 1/3 impact is gone of the three. There are other characteristics. These are the three big ones. So that one's gone. With yields as low as they are, people aren't going to move into them for the long-term return numbers. So that one's gone. So all you're really left with is people are now scared of stocks and moving into bonds accordingly, right? And then yes, you can use bonds as a diversifier now and just hold them and potentially significantly underperform what's going on in anticipation of when everyone's going to sell and come over and you'll get a gain. Right. So I'm not saying it's not it's not a diversifier. What I'm saying is it's a poor one at the current investment.
All right. Well, I'm going to say that sort of depends on what your goal is and your time frame is. And so I think, but I am going to agree with you on one point. I think sometimes, well, actually, let me back up one step. I never tell a client your risk tolerance is wrong. Right? Your risk tolerance is your risk tolerance. Yeah. Then I can't tell you how you feel about something is wrong. By the way, folks, just as a recap, we think of the distinction between risk capacity and risk tolerance. Risk capacity is your objective ability to withstand a loss of a certain amount and still not have it derail your long-term financial goals. Whereas risk tolerance is more just a statement about your sort of how unsettled you feel, and maybe then as a result, how you react based on those same market movements, whether or not they jeopardize you in any way whatsoever. And but having said that, I think sometimes people magnify what is the permanence of a loss in the stock market. And so one of the other things I was showing you fellows before we started hit record today was additional analysis that I did about the first of all, the depth of declines in the S&P 500, the frequency of the depth of those declines, and then the time to recovery for those declines. So let me just I'm not going to go through every detail, and I'm not going to show my screen, but I'll just sort of say it for the benefit of our listeners here.
Hold on, I want to stop you before you go there. I want to address two things on the
all
bond
right,
yield
fair
first
enough.
before you moved on, because the depth of decline is actually, I think, going into what my argument was earlier when we started the conversation with Dalio's bubble. But two important data things that I think are very important before you move on to bonds. First, there are different types of bonds, right? So when you're looking at bonds as a diversifier, and in this low interest rate environment, the longer term bonds will take a bigger hit if interest rates with the interest rates. Now they could be a better hedge as well for you. But that being said, you'd gone on to say clients' risk tolerance. I agree with you. You never adjust someone's risk tolerance based on just where the markets are alone. You don't take a conservative person and say, I think the markets will do well, let's go aggressive, right? That doesn't make sense. But what you do is you look at the components of that portfolio. So just as we're talking about this bond piece, the shorter term bonds I like better in this environment than the longer term bonds, right? Now the positive is you're not going to have the ups and downs of the stocks or of the longer term bonds. So you've got a little more stability. The negative is you're not going to make very much. It also won't be a great diversifier for you, which is where we started this conversation because of the way the correlation is. So if stocks crash, your short-term bond portfolios will stay stable, but they're not going to shoot up and appreciate as longer-term bonds would. The second important point, I think, with these bonds is just because it's something I track and look at, but the 20-year Treasury as of the end of May is down over 12.5%. I'm sorry, I said over. That's not down, almost 12.5. It's actually 12.4. It's down 12.4 on the year. It's a great place to be if markets crash, but interest rates have been cut so much that it really doesn't have much of a direction to go but down looking at long-term bonds. So that's where my issue with the bonds as a diversifier and interest rates come into play. Not that if the markets crash, they won't be a good diversifier for you. They will. But are you going to lose a lot of money along the way keeping that in your portfolio while the market is going up? Are you losing 12% when the market's up 12?
Yeah, no, this is not an argument. I was just to clarify, not arguing for bonds per se. What I want to try to do is, I think we were talking about risk tolerance. I think for many clients, if they say, I feel very unsettled by market declines, and many people do, it is because I think in some cases, not all, but in some cases, what they imagine is the historical tendency of those losses, the depth of those losses, and the duration of those losses, at least on paper, is greater than it actually is.
Just move forward. I think.
Okay, I wasn't sure if it was me. For those of you listening and not watching, Eric froze up on us, and I wasn't sure if it was me or Eric. So Adrian and I will pick it up until Eric joins us, because I like where he was headed with this. What Eric was saying, and it goes back to that Peter Lynch quote I just used, that I will read back to you if I can find it quickly again. He had said that far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. So where Eric was going was he pulled data that goes into the depth of the frequency of market declines, how often they go down 5% more, and then he had broken down into different bands with 5 to 10% declines and 10 to 15 and so on and so forth. The other data point he had was how quickly things recover. And what's interesting about this is you've got the typical recovery, the average from getting back up to its peak was under 5 years, right? So the question you've got to ask yourself with all this information, if you're an investor, the question that I look at all the time is okay, if things are down, in terms of the markets, or actually, let's take a step back. If you see this information come out, are we in a bubble? Are we not in a bubble? Are the markets overvalued? What are the forward expected returns and so on? All of these are just data points. You've got to then figure out, what do I do with this data point, right? Do I do something or do I not do something? And this frequency of decline, the pace of recovery, and the fact that you're unlikely to predict or call the top of the market, to me, argues for you don't do anything to predict it in advance. You do make adjustments to your portfolios. I shouldn't say you don't do anything, but for example, just using Dalio's two emerging tech versus total market comparison, well, maybe you do have a little bit less in emerging tech and a little bit more in total market. So you do make those minor changes. But when I say don't do anything, I'll talk to people who will hear or read something like this and they'll think I should sell everything and go to cash, right?
Yeah, Roshan. And could you kind of give an example to our listeners how you kind of like implemented this in 2020 with, like, we had a really sharp drop and then we had a really sharp recovery. Can you tell us how you kind of like implemented that, or how you went about like doing your analysis and just implementing that? Because I think that's a really good example. Like, if you were trying to time that kind of correction and then how quickly it recovered, like that was just like so difficult to do. So how did you kind of work that in?
Yeah, fastest decline and fastest recovery in history happened in 2020. So we've got multiple indicators we use, and we use those indicators for different strategies within the client's portfolios. So they've got multiple strategies within them. Those strategies all have their own indicators with when they need to adjust based on one is based on relative momentum compared to other investment options. One is based on absolute price movements. So we look at protecting and adjusting the portfolio at that time when things are actually happening versus trying to be predictive of it in terms of saying we think it's overvalued and it'll go down. We were looking at it waiting to go down, and that's a lesson that that I learned as part of the going back to the tech bubble, going back to the Great Recession, and then looking at last year. Every time we have these kind of declines, we analyze what we're doing and we make adjustments accordingly. So to improve our reaction to when something like this happens next. But what I learned in previous market valuations and previous times when it looked like we were in a bubble, and I referenced 2013 at the beginning. Well, the markets were significantly overvalued then based on multiple data points, and the market continued to go up. If you got out of stocks in 2013 compared to where they are now, and let's just say hypothetically back then you looked at all these data points, you got out and you stayed in cash until the data points changed. Well, they still haven't changed. Even when things went down last year with the pandemic and you saw the market decline, the markets didn't actually go into a state of being significantly or even modestly undervalued. They went from a significantly overvalued state to more like a fairly valued state. So the issue with predicting these things and timing things is that the likelihood of you being correct on both the likelihood of you getting it right even once of actually calling a top or a bottom is pretty close to zero, right? But then you've got to get it right twice. You've got to call the top and call the bottom. Both. It's just I have not found a way that can be done. If anyone has one, please contact me. I'd love to talk, but I've spent extensive hours trying to find it. I have never found it.
I mean, if you do it, they'll probably make like a movie about it, because it just reminds me of The Big Short, where a lot of these like investors were betting against the housing market, and they were doing these shorts and swaps to kind of price in with the overall market decline, I think is a really good example of like the power of being able to, if you predict it, you can make a lot, but just the timing and the rarity of it is so difficult. And I mean, we touched on a little bit with like bonds and everything, but it shows how important it is to hedging, how important hedging is. And I remember last year we were discussing, we were implementing some inverse ETFs. Is that would you say one of the best ways if you're going to short the market, or what would you say? Because I know when some people see there's a bubble or people are waiting on correction, they're always looking for ways to capitalize on it. What have you seen in the past have been some of the best examples of seeing this done?
Well, I'll tell you. So the inverse ETFs you mentioned, they can be a good way to easily try to short the market, but shorting in general is dangerous, right? So I'm not a fan of telling people to necessarily do that. The inverse ETFs can also be dangerous just because a lot of people don't understand how they work, especially if you get into the ones that are multiple inverse of the ETFs. Those need to do the inverse of what the market does on a daily basis. And then they do that using futures contracts, and they roll these future contracts. So there's a cost for it. So you're looking at multiple ways where you can be right in your sentiment if you're right in thinking the market's going to go one way or the other. However, the path it takes to get there can make it so it's not profitable for you. So I don't know that I would like any of the inverse as being. I don't not like them, right? If you understand them and use them correctly, yes. But at the same time, I'm a little leery for people to use them. So I would, as we will say frequently to people, do your research before you look into something. But as you say that with the inverse ETFs and things going down, yes, they can be used as a hedge. But once again, the question is, or not even they can be used as a hedge to protect the portfolio. They can also be used opportunistically to try to profit from it. However, you've got to have metrics with when to get in and when to get out.
Yeah, I think those are really important. And it's a quote I like that we talked about in our previous podcast. There are so many tools like securities, just asset classes where you can, if you have a certain belief or opinion or whatever it may be of the market, there is stuff out there that you can use to reflect that in the marketplace. And I think there's just, like you said, just do the research and look to see what you can use to help you look out different opportunities. I think is extremely important.
Yes, I agree. Getting back to this bubble conversation, for all of our listeners and viewers, Erik's computer disconnected and he said he has to reboot. So I want to take us back to what we talked about and give us a summary. But first, going back to what we started, are we in a bubble or are we not in a bubble? And I look at the data out there and I honestly, I don't know. From a valuation perspective and these different data points, it makes sense that we are in some, the markets are inflated, right? I'm hesitating with the word bubble just because it would make sense that we are in some early stages, but that's where my argument about interest rates comes into play, just because all of these data points don't consider the interest rate environment and the fact that Fed rates are as low as they are right now, and the Fed's unlikely to be raising rates anytime soon. I think we've got an environment where even if you thought it was a bubble or even the late stages, that doesn't mean it can't go up. And that's something that Dalio pointed out in his article, and that you can look at multiple different data points that'll say things are either over or undervalued. That doesn't mean they can't get even more overvalued or even further, undervalued, right? So whether we're in a bubble or not, to me, doesn't necessarily help you with what your investment decisions are going forward. What it can be used for is to help monitor your expectations, and you can use that when you're doing your planning. But as I said, I wouldn't jump from one extreme to another and say, oh, well, this article said we're in a bubble, so I'm moving to cash or anything else, because these things, though they're useful data points, they're just data points. And most of these things can usually, their predictive ability usually just puts you right above 50 to like the 60% neighborhood. Right. So
great point.
Yeah. So what I would tell you, if you're listening to this, is you take the data we've given you and you look at it when you're looking at your investments and where you're going to invest, and what you're going to do going forward. But I don't think you use this to make any extreme decisions or extreme moves on your portfolio. That whole thing right now for me, as far as the market's overvalued and what do you do about it, you use the information and you just see where you end up with your portfolio, how you adjust it. You adjust some of your assumptions for your financial plan, maybe, but I caution anyone to make any big moves based on this, because you never know when.
Yeah, exactly. And it really kind of, the conversation of bubbles too also brings up like the herd behavior mentality, where, I think it's like in the past, like the market is just going up and up. Is it just going to continue and have all these new buyers come in? I think is just a concept that just shown itself throughout history. But like Roshan mentioned, it always comes down to the individual, always looking at where you are personally, looking at your plan, looking at your investments and seeing whether you should make adjustments or not, and just not going from one extreme to the other. Because again, there's just a lot of information out there, a lot of just posts, like articles, where it's just hard to just move through them all and just make a big decision off of them. And just really just having that conversation, just seeing what changes you can make here and what changes you can make there is extremely important. Because just like, I think it's just one of like the most heated comments ever. Like if you just go on like a Reddit post or on YouTube and just say, oh, I think the market's in a bubble, or I don't think the market's in a bubble, you're just going to have just like a bunch of other people coming at you saying, well, my data shows that it isn't. My data is showing that it is. And just, that's why it's so important when it boils down to the individual, seeing where you are, seeing if you just need to make any adjustments along the way and going forward is just, it's just extremely important, especially now with just kind of just this frenzy and these posts just coming out constantly. Just being able to kind of stick with your investing principles, I think, is really important. And you kind of showed that, Roshan, like last year in 2020, how you're just like sticking to certain principles, sticking to certain strategies, adjusting along the way, I think is really important when you're kind of in this type of market environment. I think is really important.
Yeah, and I would definitely say that when I look at this data and what I'm going to do about it, it may be in the back of my mind as I'm doing research and analysis, but I'm not going to take any action specifically based on just this specifically, because I've done stuff like that in the past, 10 years ago and so on, and quite frankly, it didn't work out well. So I unfortunately learned the hard way with my own portfolio. Taking action on sort of data points that I think are potentially missing stuff. So I would just encourage the listener to just use this as a data point, and going back to I keep going back to what Lynch said, right? It's just that people lose more money predicting the decline than the decline itself.
And I kind of want to get your opinion just real quick on just kind of this like new, like this retail investors that are coming in, and what do you think their role is in this kind of this stock market bubble? And I kind of also want to get your opinion on how the Fed's role is in this like stock market bubble, because the biggest thing, some people are like, oh, all these like retail investors, these new people pushing up these stocks, like, is this good for the market? Is bad for the market? And then Fed seems like their only big focus is on inflation, but yet there's a lot of money pumping into this system. What do you see like kind of the roles? I know there are two big different things: a retail investor and the Fed. But what is kind of your take on these two?
Well, so the Fed, they've got to do two things, right? Maximum employment and manage inflation, right? That's what they've got to do. So that's their job. So I would say the Fed's doing exactly what they're supposed to do, and I think they've been doing a pretty good job of it so far. There's a lot of argument right now on the inflation factor, but the Fed needs more data before they make a move, and I quite frankly think that's the way to go, right? You've got to get all the data points. They're not trying to be predictive either. That would drive the economy wild. But then your question about retail investors, I find it interesting to watch and see what's going on, right? Quite the power that I think of with the meme stocks and the Redditors and what they've done with GameStop and AMC. I mean,
to me, they're creating their own little bubbles. It looks like.
And that's where now Dalio, his whole emerging tech in that area being frothy. Well, beyond those meme stocks, some of the popular stuff for those retail investors are those emerging tech stocks, right? And then there's also a lot of option use as well, which is meaning that they're using leverage. So I get concerned for those people because if you're using leverage, there's just such a high risk of loss, right? You can lose all your money really quickly when you have that level of leverage. So that I'd say I look at it in one side with what they're doing with some of these meme stocks, and I look at it in awe, and I'm like, wow, this is impressive. But then I also am concerned that they don't want to be on the wrong side of this thing when it turns.
Yeah, exactly. It's a very good point that you make. And I guess the last little thing I kind of want to like bounce off your idea is the role that SPACs are playing as well with this like kind of big market surge. And it's like it was like a big thing that people are talking about now, and now people just have a negative outlook on it. What's kind of your stance on that and the role it's been playing? Because it's pretty new thing that's entered the market.
Well, as far as the retail investors,
yes,
go. Yeah, I mean, I think there's room for everyone, right? And they're banding together and let them come in and invest. I don't, as I said, aside from some level of concern, I don't think there's anything wrong with the retail investors jumping in. And when we talk about things like the levered ETFs and the inverse ETFs, I just get concerned if someone using it that doesn't know what they're doing. I get concerned for them, but overall, I hope they come in and they learn about it. Recently, I had read about there was an article this weekend. Actually, it was the cover story in Barron's about the younger retail investors coming in and how their accounts. They can open accounts with their parents. The article is titled, "Here Come the Teens. They Can't Vote, but They're Old Enough to Buy Stocks." Right? So if
that's
you're
a clever title.
Yeah, if you're doing it right and you're learning from it, and they profile some kids that seem to be doing some things well intelligently, I think it's a great lesson. I mean, that article had me wanting to open an account like that for my kids are a little young for it, but for my niece and nephew who are old enough. So I don't see anything wrong with it. And they even reference in there that actually taking a loss with real money will teach you a lesson versus doing it on a paper trade. And Eric, you're back to join us. We did cover what you were going over with the depth of declines and the lengths until recovery. We
Fantastic.
Were just about to wrap everything up, but do you have any quick points, I guess, that you'd like to add?
No, because I don't know what was said, so I'll probably just be redundant.
No. Okay. Well, Well, we welcome you back to say goodbye to to the
Yes.
listeners. Then, sometimes talking about emerging tech stocks, right? Sometimes old school tech of basic PC doesn't do what you want it to.
Yeah, I was talking with one of my staff members yesterday, and she was telling me, Eric, my computer completely blacked out, and it was taking forever to come back on, and we just had it in the shop anyway. And I was thinking maybe it's time to replace it. But we said, let's give it another day and see how it does. And then sure enough, it must have been, I wonder if it's the same update, because mine just froze up. And when I had to reboot, it was just update after update after update. So here we are. Anyway, thanks for carrying the ball.
No, that's what we're here for. For all of our listeners, thank you for joining us. Sorry that you missed out on some of Erik's insights there in the middle with the update. And please like, subscribe, tell your friends, tell your family, give us 5 stars, and we'll be back next week for another episode of the Retirement Lifestyle Show.